estate community, a housing counseling community, and we also provide education for our loan originators that are working directly with Freddie Mac's mortgage products. The mortgage products that we offer are business solutions, especially looking at the low to moderate income buyers and traditionally underserved buyers across the country. And then, of course, we want to leave you today with some business solutions and resources and stay connected with Freddie Mac that you can use to build your business. We're going to take Q&A towards the end, so I'm going to go through the slides quickly because I want to make sure that you have time to interact with me, although I'm not there in person. So let's go ahead and talk a little bit about some of those insights. When we're looking at the millennials and Gen Z generation, we do know a couple of things. Number one, they are the driving force of first-time home buyers right now. Gen Z is following them right behind. Some of them are already becoming homeowners at a young age. When we take a look at the generations, what we also know that is they are one of the most, if not the most diverse population in comparison with other generations such as Gen Xers or baby boomers. Why is this important? Because as we're reaching out to the community to find future borrowers, we need to understand the makeup of that borrower and any particular needs or concerns that they may have so that we can help them really move the needle and start thinking about home ownership. I don't know about you, but I remember when I was selling real estate, which seems like forever ago, we heard about this millennial generation, and I felt that was so far out. And now we're already talking about Gen Z, and I'm sure there's studies that are already talking about the generation to follow. Not sure if they've labeled that generation yet, but that may be some of your children coming up. But what we wanted to take a look at is a little bit of insights in terms of the state of Washington, as also information that you're looking on the screen of King County. So we wanted to take a look at what are the opportunities. So if we know millennials and Gen Zers are driving first-time home buyers and will be for several years to come, how does that represent an opportunity for you? So if you take a look at the screen, you'll see that I'll try to move my pointer so that you can take a look here at King County. If you look at the ages 20 to 24, all the way to ages 44. So depending on what study you look at, millennials, the oldest millennial right now is roughly about 40 years old. The cutoff between millennials and Gen Z, again, depending on which report you look, is somewhere between 25 and 26 years old. So when you take a look at the opportunity of this first-time home buyer market, you have over 39% of that population within your own county that you can be reaching out to make sure that they understand the importance of home ownership. So we're going to talk a little bit more about what does that look like when it comes to the minority share. And what you're seeing on the screen is the overall US population based on the race and ethnicity. And you're seeing a comparison across Washington state, as well as how that compares specifically for King County. So you are over indexing, meaning you're above the percentage point across the US and across the state of Washington for the AAPI community. So you see that you have a diverse community, and then you can see how you fare from a county perspective as it pertains to some of these other demographics. So you are really well positioned to make sure that you're leading the charge to reach these future buyers that not only fall within the age demographic population of Gen Z or millennials, but that are also within a minority community or traditionally underserved community. So again, we like to position the data from an opportunity perspective because we do know that the millennial and Gen Zers, based on data from our data as well as NAR, will show you that they're continuing to drive home ownership. What you're looking at this screen, it will show you kind of the first-time home buyer age in terms of how old were they when they were considered a first-time home buyer. And that was about 33 years old, which is why I was focusing on the previous slide to show you the opportunities within that age group that you have not only across the state, but also within your own county. You're also taking a look at females first-time home buyers has actually pretty high. It's like 36%. NAR has another slide that's not in this deck, but it shows that single females are kind of second to married couples. Married couples continues to be the largest share of all buyers, not just first-time home buyers. Single females is actually second to that. So again, it's where are you focused on? How can you reach these potential buyers? And are you capturing their business through networking, through marketing, to understanding where they're reading or consuming their information on housing is also equally as important for your marketing strategies. We also wanted to take a look at what one of the things that has impacted millennials, not only millennials, I say millennials and Gen Zers because they're more accustomed to it. But I think, in the midst of what the world just went through with the pandemic, you have also seen a rise in what we call the gig economy, right? These are individuals that are now hybrid, that may not need to go into an office every day or may not need to go in an office at all. So what you're seeing is potential increases of what we call migration, either inbound migration or outbound migration. Most individuals that are leaving a state that's considered a high cost market are going into states that are more affordable. And I say this lightly, I'm dialing in actually from New York, a very high cost market. So if I were to go purchase a property, let's say in Colorado, I may find those homes priced more affordable for me based on what I'm used to paying in New York. But for the people that live in Colorado, they may not see it the same, right? They may see those prices are much higher. You may be seeing an influx of folks from California. They have a negative 322,000 migration. On the ground, so you can tell me better than anyone. Are the buyers that you're working with? Where are they coming from? It should most likely be reflective to some of these states that you're seeing here with a negative migration, such as California, North Dakota, Illinois, Louisiana, and others. So I like to call this particular slide my referral slide. And that's wearing my real estate agent hat. I would want to know where are they coming from, and am I networking with agents in that market so that they know that I am an agent in the state of Washington, in King County, to receive those referrals. So again, I call this my referral slide. Well, we also wanted to take a look at, we don't have the data for 2022 yet. All of these things tend to lag a little bit while the data is collected. But this was looking at NAR study at the states that were considered whether more affordable versus least affordable. And this shows you there were some states that dropped off and then others that, made it to the least affordable states in 2021. Again, this is always going to be fluid depending on the market, depending on new housing stock creation or other plans, whether that's, manufactured housing developments that may have California, and as well as primarily a lot on the West Coast, you have a lot of the ADUs that are being created. So again, looking at these, curious to see where 2022 list is going to fall. Unfortunately, New York was the least affordable, both 2020 and 2021. But again, this is just to kind of give you an indicator as to affordability, as well as some of the migration patterns that you are seeing. So now we're going to dive into some additional study that we did in terms of mortgage ready. And what does that mean at Freddie Mac? So mortgage ready, this research was done by our data analytics team. They wanted to look at individuals that were 45 years or younger. The reason for that was that was most likely where we were going to find more of those individuals that currently did not own a mortgage. So this is for research only. It's not specifically to the credit guidelines. What we wanted to look at was if they had credit profiles that were positive, then we would categorize them as mortgage ready. And if you look at the screen, what you're seeing is three categories: mortgage ready, near mortgage ready, and not currently mortgage ready. Some of the main differences, as you can see, primarily are going to be three things that were being looked at. Number one, what was their credit score? Number two, what was their debt to income ratio? In addition to that, did they have bankruptcies or any 30 or 60, 90-day delays on their credit report? Understanding that also there may be some individuals that are credit thin profiles, right? That they're not using credit, whether it's because they're younger and maybe they haven't accessed credit yet, and or culturally from different race and ethnicities don't have the same relationship that we may have on the what I call the mainland, being born and raised in the United States with credit. So again, this is just to show you the opportunities from the mortgage ready standpoint. So the way we broke it down for this presentation, we wanted to show you Mortgage Ready as it pertains to the different race and ethnicities, as well as one of the biggest myths out there, that you need 20% for a down payment. So I don't know about you, and I always say this because if I thought that it was going to take me 18 years or 20 years to save for a 20% down payment, I would never even step into your office. But if I knew that there was a 3% down payment option, and that I can start getting ready, and that within maybe 2 to 4 years, I would be able to buy a house, most likely I would start that conversation with you sooner. So this is one of the things, is a pet peeve of mine. I always say we need to start not defaulting mortgage calculators to 20%, because if you use most apps, they will default to 20. And therefore, we're contributing to that myth that you need 20% or that you need perfect credit. We also wanted to take a look at the mortgage ready population across the US as it pertains to generational. So what you're seeing is actually for older generations, it's going to take them less time to save for a 3% down payment, but that's natural. They're most likely, if you look at the Gen Xers, baby boomers, they've been in their careers longer, have been able to save, potentially have double household incomes. So that's no surprise that it would take them less time than somebody in a Gen Z or even a millennial population. So again, this is that myth of really trying to demystify the 20% need for a down payment option, especially those individuals that are in high cost markets are going to be on the higher threshold of saving for a down payment, because they're putting so much towards their rental income, right? So the income is going towards rent, leaving a little bit less money to save. But this is where down payment programs and low down payment loan products are going to make a difference for these particular buyers. The next thing I wanted to go into is what are some of the barriers based on the studies that we've conducted, as well as some of NAR studies. And what you're seeing is that individuals between the ages of 25 and 40 are really seeing that down payment is the biggest barrier. So what are we doing for that? We are looking at solutions to make sure that we look at student loan and how we calculate student loan differently than some other conventional products. We're also looking to make sure that we do have a 3% low down payment option for those buyers who cannot save 20% for a property. Of course, they'll need mortgage insurance with that, but we'll talk a little bit about the differences of our conventional product maybe versus an FHA product in a few minutes. But this is what is holding back a lot of the homeowners. I'm sure you're seeing this in your market. And what we're saying is, what can we do to overcome this? Again, we focus on the education, we focus on the 3% down payment, plus we also focus on layering financing with down payment assistance programs and grants that actually exist. When you also take a look at first-time home buyers between the ages of 22 and 25, you're seeing that understanding the mortgage process, understanding what it takes to qualify, also is one of the largest barriers that they perceive to homeownership. So that's where you come in, because we did a study in 2020 where we had 1,500, a little bit over 1,500 real estate professionals that we surveyed. And they told us that 77% of the time, the buyer comes to you as a real estate agent first before even going to their lender, right? So they're counting on you as that trusted advisor. And I know you're going to have a panel of lenders and subject matter experts that can help you understand how to qualify for these programs, because again, we don't lend directly. We rely on our lending partners to do that in conjunction with the work with the real estate agents. What we also looked at, the millennial generation is one of the most, if not the most, educated. They have bachelor's degree, doctor's degree, some have multiple degrees. But one of the things that the study showed is that they are less financial capable. Some don't even know how to write a check, right? A balance a check, a lot of fintech tools. You have all these apps. I can't even keep up with them. Cash App, you have Venmo, Zelle, and others. So it's really easy to use these apps and not really manage your budget. So this is an opportunity to provide education around financial capabilities. And we actually have a program called Credit Smart Suite. And that Credit Smart Suite really does provide you, as well as the buyer, educational opportunity at no cost to them that can teach them about budgeting, financing, saving for a home, understanding rental, understanding credit, and setting credit scores, and so on. But what we also took a look at was when it came to down payment, first time home buyers tend to look for family members as well for some of that assistance, which is where wealth building through home ownership is so important, especially for those traditionally underserved communities. Because if you have individuals, that parents that are being able to create wealth, have equity in their properties, most of the time they will take some of that equity to help their child purchase their very first property. But sometimes you have a gap when it comes to the minority communities. So what is Freddie Mac doing? We talked about the Home Possible loan. I'm going to talk a little bit in detail about that, as well as our Home One. So let's go ahead and talk about Home Possible. And I know I can't see all of you there, but I hope that you have heard about Home Possible through your lending partners. But Home Possible is what we call our affordable loan. This is specifically for individuals that make 80% or less of the area median income. And I'm going to show you where you can find that information for every single one of your listings. But we do look at flexibility for borrowers, and you can speak to your subject matter expertise on the panel a little bit about this program. But it does provide some flexibilities. It is not only for first-time home buyers. It could be a move-up buyer, a no cash-out refinance buyer. But what this loan does, it allows individuals to enter home ownership with as little as 3%. It does allow for non-occupying borrower income. So if a parent wants to co-sign for a child, as an example, they can. They do not need to live on the property. It is also available for 3 to 4 units. They do have to give more down payment. They have to give 5% versus 3%. It could be layered financing with down payment assistance resources. It is 1 to 4 unit as well. So if you have multifamily opportunities there, they can actually purchase with the Home Possible loan. So this is this loan specifically condominiums, manufactured housing, single family, 1 to 4 unit, as well as does not have to be a first time home buyer, but if they are a first time home buyer, will require first time home buyer education. Here on the screen, what you're seeing is some flexibilities in terms they can now provide rental income. So if you have an individual who's been roommates and had roommates for several years, and they now want to purchase a property and the roommates are coming along with them, they can actually use that from a qualifying standpoint to be able to qualify for Home Possible. And then it shows you some other flexible resources that are available. And again, we'll show you where you can find a deeper dive training on these products, as well as picking the brain of the SMEs that are on your panel today. We also have a program called Sweat Equity. This is when individuals actually can use their skills. If they're labored and they know how to do labor, they can use some of those skills to be counted towards their down payment funds. In the presentation that we're going to share with you, this little video, click here, and I have to click right here. If you click, I won't do it because of time, but if you click on this video, it will take you automatically to information about the Sweat Equity Program. But this is a great way for individuals to be able to use their skills to kind of minimize that out-of-pocket cost that they have to purchase that property. And here's just some scenarios. One, I kind of talked a little bit about it. You have a young family who's moving into a larger property. Maybe they're, wanting to make sure that their parent helps them. They can use a non-occupying borrower. You have a renter with roommates. They can use that rental income. So again, your lender can help you understand what they will need from that buyer to qualify under any of these particular guidelines. And they always have training available online through Freddie Mac. And they also have a 1-800-FREDDIE number that they can call Freddie Mac if they're in the middle of a transaction to get assistance with that particular loan. If you have listings and you're curious what's happening in the market or what down payment resources are available, this particular slide will show you. I actually entered an address in King County based on what I looked up. This is an active listing right now. And what it showed me is that for this particular address, the income limit for Home Possible, which is 80% or less, would be a household of $99,680. It also tells me that if I wanted to click on this link here, again, because of time, I won't do this, but you can actually click on the down payment resource. And based on this property address that I entered here, it will tell me what down payments are available with a link to the down payment site. So it will take you right there and let you know what that buyer would need to qualify for that down payment program. So I love that link. I would, if I was selling real estate today, I would be looking at all my listings to see what was available. This is a quick comparison for Home Possible versus Home One. Home Possible on the left is what I said, 80% or less of the area median income. And it shows you, it could be a fixed loan, it could be an ARM with higher interest rates. You're seeing a little bit more of that, but no cash out refinance. The difference between a Home Possible and Home One for Freddie Mac is that Home One can only be used for one income property. 2 to 4 is not permitted, and it is for first-time home buyers. The difference also for Home Possible is that Home Possible is the MI, the mortgage insurance premium, is calculated at a lesser rate because it is our affordable product. So they're only calculating at 25%. There's no upfront MI premium, so mortgage insurance premium. Plus, they can remove the mortgage insurance premium once they have 20% equity. It will automatically fall at 78%. So what you want to do is make sure if they are financing through Home Possible, that once they have 20% equity, they can call, or 22, they can actually call their servicer. 20 they can call, 22 it would automatically drop off. Home One is for those individuals that are above the 80% area median income. There's no income limitations, no geographical limitations. The difference is the MI is a standard MI, which is 35% calculation, but they can remove the mortgage insurance also with the same criteria as Home Possible. So this is great for your higher income earners. When you take a look at resources and tools, we wanted to make sure that we left you with some additional resources that you can access after the presentation. These are a few that I'll mention. There's many more, but I wanted to keep to the ones I thought you would most likely be interested in. One of them is a consumer-facing tool, which is myhomebyfreddiemac.com. This is consumer-facing. You can go in there yourself. You can take a look at what's there, but then you can share this on your social media links. You can share this to individuals that stop by your open house so that they can access this free information from the Freddie Mac website. We do not advertise real estate companies. We do not advertise any of our lending partners. It is strictly educational. There is also this other component, which is called Credit Smart Suite. On the left-hand side, you'll see that's called our Credit Smart Essentials. That's focused on not only first-time home buyer, primarily budgeting. It has a budget sheet. It's mobile friendly. They can actually create goals, smart goals for themselves, create a profile, and it will help them better understand their financial capability before purchasing a property. There is a military module that we worked with the Veterans Association of Real Estate Professionals. So great resources there. And it is also available in multiple languages. And last but not least, on the right-hand side is the home buyer education. So if they are using a Home Possible loan or a Home One and they're a first-time home buyer, they can get the home buyer education fulfilled through Home Buyer U, and that is at no cost to them. It is free. It is a Freddie Mac program, and they can do this online, and it is also mobile friendly. Last, because I know we're short on time, I wanted to leave you with 2 more slides, and that was really for you to take a look at engaging with us. We have a real estate professionals website. This is specifically for you. This is not consumer facing. This is for you as a professional. And you can actually look at some of our research, our white papers. You can actually access some marketing tools and some social media posts that you can post directly from our site to your own social media handles such as Twitter, Instagram, and so on. So I do encourage you to log on to our Real Estate Professional Resource Center and engage with us there. The other thing I wanted to cover today is that we also launched a free 3-hour CE credit course. It is approved for the state of Washington. We actually have 3 more coming up. We tend to market them market specific, but if you attend any of these 3 sessions and are licensed in Washington, because the course is approved in the state of Washington, you would get your 3 hours free CE course. It is called the Neighborhood Real Estate Professional Services. And you can see here the 3 dates that are coming up. Again, there's a QR code. You have to pre-register for the course, and it follows the state guidelines and requirements for you to obtain your CE credits. And we do this in partnership with one of our vendors who provides this for Freddie Mac, but we completely offer the course at no cost. Last but not least, I wanted to tell Marissa thank you and the entire committee for bringing me on board. I was hoping to be there in person, and thank you all for being here today. We do go out and do these sessions on a regular basis. Our team is nationwide. When we can, we like to be there in person instead, but today we were able to do this virtually. But love to hear from you. Please provide your feedback. Please engage. And if you do 2 things today, is definitely sign up to receive our real estate professionals information, and then please provide some feedback about this session. And I think, Marissa, we were going to open it up to maybe a few Q&A before I drop, because the real important people are sitting at that panel waiting to talk to them about what's available local to them. And that's really what is important, because real estate is local. So Marissa, I'll pass it back to you.
Thank you, Carmen. Can we give her a round of applause, please?
Oh, thank you.
Does anybody have any questions for Carmen before she logs off? Yes, here's
I
the
do.
front.
So she was talking about the Credit Smart Suite, and there was one before that that I just didn't have time to write it down. What was that one that she mentioned before that?
The Credit Smart Suite. Did you hear that, Carmen?
Yeah, I did. Actually, the audio is great. Thank you, by the way. I hear the audio fine. So this is the Credit Smart Suite is your essentials, the Credit Smart Coach, military module, and multiple languages.
My question was, what was the program you mentioned before Credit Smart?
Oh, the program. Sorry, the My Home Freddie Mac is this one.
My Home by Freddie Mac. Okay, thank you.
And
You're
everybody,
welcome. And you're going to get these slides. You're going to get these slides, so you'll be able to click on the links as well.
Oh, awesome. Thank you.
You're welcome.
Any other questions for Carmen? Yes, Roger.
Yeah, just on the Home Possible, it's probably an underwriting question, but on a non-occupant co-borrower, does it have to be a family member, or can it be anyone?
No, that's a great question, and want to make sure I heard it. So does it, the non-occupying borrower, does it have to be a family member? Is that what's the question, right?
Correct. Does it have to be a family or not a family?
So it doesn't have to be. It's if they have a friend who's willing to be on, the loan with them, that could be fine. That's not usually where they want it to be familial is normally when you're getting a gift. Right, when you're getting a gift. So if somebody was giving me $5,000 or $2,000 for down payment, they're going to want to see some familial status there, right? Because they don't want to think that it's going to be a loan that needs to get repaid. But again, I'm sure the lenders there can answer those questions as well. But on the non-occupying borrower, no, they do not.
Okay, and are you going to be using their income to qualify? Are you also going to hit them with the debt? Do they have to? Are you hitting with the non-occupant co-borrower debt to qualify with the ratios?
They are going to have to qualify based on our guidelines on the ratios, right? So it's a holistic view. The lender can actually pull everything through LPA or DU. Freddie Mac uses the loan product advisor, right? So they'll have to put things into loan product advisor. When they're there, the loan officer, it will give them a certificate message saying, this loan qualifies for Home Possible, please resubmit. So if it gives them that, they can actually then put it through Home Possible. So they'll know right then and there whether this is an opportunity for them to put that loan based on that particular borrower's criteria to Home Possible. And if they're having, if they do need to do a manual underwrite, they can do that as well.
Great questions. Any other questions before Carmen logs off? Yes, Chris?
On the same thing, on the Home Possible, the non-occupying borrower, does their income count towards the AMI?
Great question. If they need the income to qualify, then it will be counted. If they do not need the income to qualify, then they don't need it, right? So it's the income that is needed to qualify for the loan. So if they can qualify without it, then they don't need it.
Understood? I see another hand back there.
Yeah, question. When it comes to tenancy in common, right, say there's 4 different Would they each apply for their own loan, and would that work at one hospital or because now you're talking four different, like, four different owners of different percentages. How would that work?
Yeah, I think I heard something in tenancy in common. I don't think I'm the right person to answer that directly, especially because of the different laws and in each state. I would have to find out information on that for you. I don't have that. I don't know if one of the lenders may be able to, or even a title representative for you. But if not, Marissa, please, if you can let me know who asked the question and send me, I would definitely get an answer for them.
We can connect afterwards and I'll make sure to get an answer.
Yeah, I don't want to give the wrong answer. I'd rather look at it, find out really internally if we do have an answer or a guideline around that.
Thank you. So we will go ahead and start with our panelists here. Thank you, Carmen, and I'll see you in Miami.
Thank you very much. Enjoy
Thank
the
you.
rest of the session. Thank you.
I'm gonna go with you.